You heard from Harish Salve, Mukesh Bhutani and others earlier in the day. Let's talk to two other gentlemen who are joining us now to talk us through the implications of the amendments to the Mauritius tax treaty. We've got Mr. TP Ostwal joining me right here in our studios in Mumbai. Mr. Asim Chawla is with us as well from our Delhi studios. Gentlemen, good morning. Great to have both of you here. Mr. Chawla, I believe it's your birthday, so wishing you a very happy birthday from all of us here.
Yeah, couldn't have
and if
been
you don't mind me
time.
asking, how many years younger, sir?
Well, not as, I think I've withstood about 41 now.
Okay, 41. Okay, so congratulations and good luck to you from all of us here. You know, I just want to start with the very short, very quick answers so I can get as many questions in as possible. Mr. Ostwal, what's your first take? Desirable, undesirable? The changes which have been made.
Looking at the global environment in which the things are happening, the BEPS and the G20's initiative in the OECD all put together, and the GAR coming in from 2017 in the country, which has been the intended move by the government. The Mauritius Treaty anyway would have become an obsolete document. With this, at least they got a life of few years. And grandfathering clause, which particularly they have put it in the investment capital gain article subject to some riders, is an excellent move for next 2 years, or for grandfathering at least it will be move perpetual. And therefore, in my opinion, the only concern will be the new investor coming in from 2017 up to 2019, they will get a concessional rate of tax for a short-term investors. Long-term investors are not to worry. But the investment after 2019, all the transactions will be subject to level play field. Everybody will be on the par. The most important implication of this change is that Singapore Treaty got automatically amended. Mauritius, with the same simultaneously, Singapore also will impact it. So therefore, Mauritius and Singapore, when they were competing jurisdictions to make investment into India for the purpose of attracting foreigners, whether you call it a genuine investment or a conduit investment, now they will have the level play field between them. So I believe the move seems to be in a right direction. The government of India cannot expect to lose, and if the foreigners make money of 100 rupees, paying 7.5% tax on that profit should not be their concern. If the returns are there, they will have to pay the tax. And possibly they will calculate their gain first of all in the foreign currency, and then find out what is the net profit. On that only they have to pay the tax. And therefore, in my opinion, they get double advantage. First is that indirectly they got indexation, indirectly, not directly. And because the difference in the foreign exchange will be computed, and then the gain will be taxed at the 7.5%. So after 2 years. But in my opinion, up to 2017, it will propel investment, and therefore it is a move from that perspective. Government of India is expected to garner quite a good investment up to 31st March in the current year.
So the point about you saying that flows may increase.
Yes.
Leading up to 1st of April 2017.
Yes.
But the tax is going to be calculated on when it is the gain is made, right?
Sold. When the investments are sold,
right,
the tax will be calculated.
So,
then you first calculate the gain. The gain, while calculating the gain, you calculate in foreign currency because you are invested.
No, I'm saying so if you made an investment now and you sell in say March of 2017,
yes,
the date of sale is what matters, right?
If you sell before March 2017, nothing is taxable if you are a Mauritius investor.
Right. No, so why are you saying we may see a surge of inflow?
Surge of inflow because they have grandfathering. Anybody who has made investment prior to 2017 March, he will continue to get the exemption which is provided under the old treaty. And therefore, even if he sells later on, his gain will not be taxable. And therefore, foreign direct investment and FPI, both will get attracted if they are a long-term investor. So long-term investor will be benefited. Short-term investor has a concern because they were getting exemption totally because of the Mauritius and Singapore Treaty. They were not paying any 15% tax on a short-term capital gain. That short-term capital gain will become taxable after investment made after 1st April 2017. So that will be a concern. But if the investment is made prior to 2017, even a short-term capital gain will be exempted. And therefore, because of that, to take advantage, possibly the investment will flow up to that date.
Right.
And then thereafter, there are techniques people will use, stepping up of the cost by selling right now and then buying later on if the markets are up, so that the increased value will be getting as a deduction, and therefore capital gain will narrow down.
Okay, Mr. Chawla, we were talking offline before you came on, and you were talking about you pointed out that the limitation of benefit clause, right?
Yeah.
Where you will have to now show substance in Mauritius to be able to take advantage of the 50% concessional rate for 2 years, right?
Yeah.
And then of course, then everything the exemption is completely gone.
Yeah, main purpose
starting financial year 20. Is that going to be a difficulty?
Well, main purpose test would again be a qualitative sort of a criteria. In 1st April 2017 is when the general anti-avoidance regulations do come into play, which are already legislated in the scheme of the Act, and few of these connotations are part of the chapter dealing with general anti-avoidance regulations. So that's a qualitative test where there would be some exercise of discretion, which we believe should be reasonably and judiciously exercised. The other is how much expenditure you are incurring, which is about close to $1.5 million Mauritian rupees or so. Now, generally it is widely believed that this amount could be on a higher side when you just look at what annually the companies are paying to management companies in so far as their obligations are concerned. But then the whole question is that it should not be a shell or a conduit company, which presupposes the fact that you may or should have an active P&L account or a profit and loss account. In other words, you're doing something, and if you're doing something, of course, there is an active profit and loss account, and therefore a reasonable amount of 1.5 million Mauritian rupees has been benchmarked as the amount. So in any case, if the balance sheet or the affairs of the company are inactive, so to say, then breaching this bright line test of 1.5 million Mauritian rupees may be a tall order, so to speak.
No, but the thresholds generally are quite low. Mr. Ostwal, you want to come in on that?
Yes. What Ashim says about the limitation of benefit article, the threshold provided here is significantly lower. If you look at the Singapore Treaty, we have a threshold that the 200,000 Singapore dollars should be expenditure. It means a crore of rupees. Whereas in Mauritius Treaty, they have provided 27 lakhs of Indian rupees expenditure. And in 27 lakhs of rupees Indian expenditure means around $4 lakh, around $40,000, which is nothing. In my opinion, this is the fees anyway the foreign FIIs or any fund is paying to the service provider in Mauritius on account of the audit fees, on account of maintenance charges, on account of license fee to the government. And if this is believed to be a substance, then in fact all other treaties also should ask for this substance test in their treaty also. The only point which Ashim has said is that the purpose test and the other is a bona fide business test. How it will be applied and how it will be used is an issue by itself. But all these companies are investment companies. They are they are making investments. So the business purpose is fulfilled. The prime test is fulfilled. The purpose test is also fulfilled. Then only condition which they have put it is expenditure test. And I don't think this is difficult for anybody to prove 27. And my experience is people are spending more than 27 lakhs of rupees. Mauritius has been very smart in negotiating the treaty with India with such a low threshold of an expenditure. And Government of India, looking at the fact that we are a big brother for the Mauritius, they are all our elder brothers, we have accepted this proposition. So I think we should compliment both the sides, having negotiated very properly, and therefore continue the spirit of the brotherhood relationship.
Okay, that's a nice way to put it. So this one point, automatically the rules for Singapore-based investors also get realigned, Mr. Ostwal?
Yes.
Automatically?
Yes.
No separate clarification, nothing is required.
I don't think it will be required, but nevertheless, our government of India has been, in the past, the experience is whenever the most favored nation article gets kicked in, they generally notify that. So they will notify immediately.
Some housekeeping should be expected. I mean, in 2005, when the protocol came in Singapore Treaty, and that was also a protocol, much like this, which is also a protocol. So some housekeeping would have to be done, which we heard from the ministry yesterday.
Yeah, but
what needs to be
a formality now, right? You would agree, Mr. Chawla. That is a formality now, right?
Yeah,
I'm saying that is a formality.
But I thought there should be some thinking which needs to be done, because what happens to the Indo-Dutch treaty, what happens to the Cypriot treaty, which is in limbo because you've already blacklisted Cyprus, considering that if capital gains beneficial tax treatment is in the spotlight, then you have two more treaties to talk about. So I'm sure the government has thought through it, as Mr. Ostwal is suggesting. There would have been some amount of thinking which has gone through. Already two high courts have ruled negatively on the challenge with regard to so-called blacklisting of Cypriot treaty under section 94A of the Act. We recently had the Madras High Court decision. Before that, we had the Uttarakhand High Court decision saying that it's an executive decision, so no judicial interference is called. Now, what happens to the Indo-Dutch treaty if you're looking at capital gains tax beneficial treatment? Will it stay, or the LOB indicator, so to speak, which has been put forth in the Mauritian protocol?
How large is that? Treaty in terms of getting flows in? The Dutch treaty, for example, or the other one?
It has been somewhat favorite, if not very favorite, of the investors coming from the Western world. But many of us do believe that the Dutch treaty is fairly a robust treaty, so to speak. I mean, the whole framework of Dutch taxation and the way Dutch laws have propelled cross-border investment, I thought it's a heritage and a vintage treaty in terms of its treaty network, so to speak.
Yes. What Asim says is correct. I don't think there is any concern the Dutch will have on application of their Mauritius treaty to them. It is for them to renegotiate, because this will be a full-fledged renegotiation, and that is not going to happen over the next 2 years. And in any case, after 2 years, the whole taxation of Mauritius becomes fully taxable. So therefore, why should the Dutch negotiate with India? That is one. There are a number of other treaties which are also similar benefit available. But the problem which he has pointed out of Cyprus treaty with India, which is in limbo right now, and this was a concern. The government of India wanted them to renegotiate the treaty, and they were not ready to renegotiate. They were all waiting for Mauritius. What happens to Mauritius? We will look at that. Now, if Mauritius has gone, so they will fall in line. In my opinion, there are some other 1 or 2 concerns under that treaty, but this was another major stumbling block. Capital gains were exempted. Another important change, if you look at this treaty, the withholding tax on interest which has come in the Mauritius treaty, which was not there earlier, which is a very low threshold. They have said about 7.5% for the bank payment, which was 0 earlier. But how much is the other interest? We have not got the details. I suppose that could be not more than 10%, because in all other treaties are there. And that was the benefit Cyprus had, and therefore all the debt investments were coming to India was coming from Cyprus. Now it will come even via Mauritius. And another important feature is, despite the fact that this Mauritius treaty is amended for, and which has an impact on inbound investment, this treaty is beneficial for outbound investment. And if there is any change or not, that can be seen only when we look at the fine print. That fine print is not been so far available.